Thanks for tuning into this broadcast of the Resilient Advisor Podcast. My name is Jay Coulter, and joining me for this episode is my friend Lenore Hawkins of Tematica Research. This is part of the Tactical Market Strategy series, and with Lenore, we talk everything macro. One thing listeners should know, Lenore is a San Francisco 49ers fan, and today is the day after the Super Bowl. So let's start with this, Lenore. How you feeling?
That was tough. That hurt. I'm trying to be very positive and think we had an amazing season. We had a really great season starting off. We didn't think we were going to get that far. And just game after game after game, it kept getting better and better. But man, I could have really done without the fourth quarter last night. That hurt. That's going to leave a mark.
It's going to leave
Still wearing my jersey today, though.
Listen, as an Atlanta Falcons fan, I can tell you not only does it leave a mark, it's something that you're going to hear about for a long time. Doesn't get
You've been there with Kyle.
But it was a fun season for the 49ers, and that was a great game for everybody that wasn't a 49ers fan.
Yeah, you know what I really missed? I wanted another one of those Kittle scenes, Kittle dragging a bunch of defensive men down the field, and we didn't get any of that. What we got was a really nervous team. And poor Kyle. Kyle's like, oh, I'm cursed. Here we go again.
I know. Well, he's got the makings of a good run there with all of the talent he has in San Francisco.
Amazing.
Almost equally as important is the GDP here in the United States. For those of you that are new to Lenore and I, we love charts. When it's her and I, there will be lots and lots of charts. Let's get started with GDP. What do you see?
So we just got the GDP print, the first estimate for the fourth quarter. And it looked pretty good, came in as expected at 2.1%. So if you just looked at the headline, you'd think, well, it's not terrible. I mean, 2%, to be fair, is kind of limping along. You look at our historic norms, it's not anything to get too excited about, but it's not terrible, right? So why is everyone being so fussy? Well, if you look into the details, because the way GDP is calculated, that matters. Looking into the details, you see that a big chunk of where that growth came from was actually a decline in imports, because imports take away versus exports give to GDP. We had a huge, I remember that trade war. We had a huge cut, 8.7% annualized decline in imports in the fourth quarter. And that alone added 1.3% to GDP. So it was only 2.1, it added 1.3. We also saw, it's worse, we also saw a big increase in government spending. Government spending, that increased 2.7% annualized. Now, if you put the government spending, take that out, because government spending, that's not the private sector. That's not the economy actually growing. And if you get rid of just kind of the mathiness of the decrease in imports, you're left with 0.2% GDP growth, 0.2. So really what's keeping us afloat was a temporary thing in import math and the government spending. Is that an economy that's booming? Not so much. Now, the thing that really got me worried about it was the real final private demand. And that's really what's going on in the private sector. And that slowed to its slowest pace in 4 years at just 1.4%, dropping from 2.3% in Q3. Now, that doesn't look so good. And you've probably been hearing, too, about all this business investments, right? So it's just not happening. That was part of what the Trump tax cut was supposed to get businesses to invest. Because when businesses invest, they buy stuff. That buying stuff means more jobs, more activity in the economy. Well, business expenditures contracted at a 1.5% annual rate in Q4. That is the third consecutive decline. So that's not telling me why that headline was like, oh, it's good. It's what we expected. No, not really when you get down into it. Now, the one bright spot, though, for investors is that government spending is really focused in defense. And that continues to go up. We saw a 4.9% seasonally adjusted annual rate. So that's pretty bullish for investors when you're looking at any kind of stocks in the defense sector.
So I heard a new technical term in there, mathiness.
Yeah.
I like
mathiness,
the mathiness.
Yes. The mathiness.
Yeah. So a lot of great data there to unpack. Let's take a step back from just a minute and look at the economy through the lens that you and your partner Chris Versace always talk about: government, business, and households. Can you break it down a little more along those lines?
Yeah, when you look at these numbers, it can get kind of confusing to try and figure out. This seems like there's a lot of moving parts. So what we did in our book, Cocktail Investing, was break the economy into just three components. If you think about it, it kind of makes sense. There's government, right? There's businesses, and then there's households. That's all you have in an economy. So if you look at it in that light, you can break down what's going on in each one of those, and then that makes it a little simpler to say, okay, get a big picture of what's going on in the economy. Now, given the headlines recently have been dominated by a lot of government level topics from impeachment to the coronavirus, let's just start with what's going on in government. Now, when you look at government, there's really just two things. And you hear a lot of things, government does this and that, but really government, all they do is they have fiscal policy and they have monetary policy. Now, all that means is fiscal is they tax you and they spend, and monetary policy is the Federal Reserve, right? That's just printing currency or cutting it back. That's controlling exchange rates. That's it. So when you think about government, just think about that. Now, if we look at the fiscal side of things, the government is spending, and I think we have a chart here for this, the government is spending at a level that we've honestly never seen outside of a recession or a war. That's kind of interesting when you keep being told that the economy is doing fantastic and yet we're spending that much. Now, the reason the government spends typically either it is a war, right? So you've got to spend on defense, or it's a recession. And the reason the government spends more in a recession is it kind of tries to be the buyer of last resort. Everybody's panicking, there's a recession, everyone stops spending, and the more people stop spending, the slower the economy goes. So the government hops in there, and it's kind of this idea of a floor. Hops in, starts spending, hiring people, building roads, building infrastructure, and that creates buyer that wasn't there. But we're seeing level normal is really, really struggling. So two things there. One, look at that like we just discussed. Look at that in light of how we're doing. And also think about recession, because we haven't ever been able to get rid of those. That's just kind of a natural thing. Spring, summer, fall. Now, paying attention. We're in really unprecedented times when it comes to monetary. But last fall, the Fed has had this tapering. You might remember the quantitative easing wasn't just buying lots of bonds, put it on their balance sheet, and they would put money into a bank, and then the bank did. That's how they get more currency. That's how they get liquidity out. Well, while they were they bought a lot of things, a lot of bonds. At some point, they decided, all right, we don't really want to. So they did tapering. Now, tapering, all that meant was they weren't buying anything new. So, right, you get the cash back. The cash came back into the Fed, and it didn't go back out to the market. Did a bunch of that at balance sheet, and then I remember hearing about this idiosyncratic liquidity that they were having. Liquidity a couple days. Well, it's a tax thing. Well, it's a strange occurrence. Well, they're still providing liquidity now through the over about % peak of easing. Now that tells you there's definitely still a liquidity problem. So you've got is doing fantastic. You've got spending, the likes of which is normally in a war recession, and you've got monetary policy that is extremely accommodative by historical norms. So put those two together, thinking of a story. So let's look at another component of the economy. Businesses. I keep hearing, businesses are doing so fantastic. Let's not talk about. Okay, well, we're going into the fourth quarter of contracting earnings for the S&P 500. Meanwhile, the market has been skyrocketing. And what that means is that people are just willing to pay more for every dollar of earnings. That's just a multiple expansion. And you see a multiple expansion if like future, we're going to see some sort of great growth. Not really sure, but getting the idea that that's going to real hard realities here. In the United States that are actually losing money in months has hit 40%. So 40% of all listed companies in the United States are losing money. the highest level in 1990s outside of the post-Great Recession crisis. Now, one way to
Lenore?
look at, and we have a chart on this one too, the best way to look at economic activity. Yeah.
Hey, Lenore, we're having some latency issues. We're missing a lot of what you're saying, unfortunately. Could you talk a little bit about this slide from the from the Federal Reserve? Because I think that you're trying to make a point here about business spending in the economy. Is that correct?
Sure. Oh, are we looking at the lending? Yeah. So one of the best indicators of economic activity is to look at lending at bank lenders and commercial and industrial credit, because that's kind of the base tool for operating a business. And year over year, if you look at lending and commercial and industrial credit, it's utterly collapsed. Core, the base economy, actually the economy is collapsing. They're not going for new loans. Now, borrowing from banks, that wouldn't be so bad. We were seeing if we're seeing companies, instead of going to banks, if we were seeing them go and so well, unfortunately, the total amount outstanding of commercial paper is well below where it was last July. So the two places that banks borrow from, or companies borrow from, banks and the public market with commercial paper, both are seeing borrowing really go down. So that's not telling me that business is growing. How's that? Okay. That catch up?
Yeah. So I apologize to viewers. We're having some latency issues here. So a couple of key points on some of the charts that Lenore mentioned. I'll put the charts in the form of links in for the replay viewers. Why don't we move on to the commercial paper outstanding, Lenore? And I apologize for being choppy with this. It has to do with some of the latency we're having here.
Sorry. So the commercial paper, that's just what we're saying with that the banks aren't lending to companies, nor are companies borrowing from the public market. So you put those two together, that means that companies really aren't borrowing. They're not borrowing because they're not needing to add to future productive capacity. And that tells me if companies aren't looking to add to future productive capacity, that tells me that they're not seeing accelerating growth in the future, which is very contrary to when you see the PE to earnings multiple skyrocket, which is what we've seen, right? Because the S&P, 4 quarters of declining growth, yet stock prices have gone up. That means an expanding PE. If companies aren't borrowing, though, to expand future productive capacity, then they're not seeing this explosive growth in the future, which contradicts an expanding PE. So that's like, if we're just looking at what's going on in companies themselves. Now, if they're not borrowing, and yet we keep hearing about this really strong employment, right? That's going fantastic. If you look at the year over year change in job openings, because forget today's employment, right? People tend to fire employees at the last minute, right? Nobody really wants to fire somebody. What you want to look at is more of a leading indicator, and the closest leading indicator you can get within the employment is job openings, right? Because that's people I'm looking to hire in the future. The year over year change in job openings is at levels we have not seen since the financial crisis, falling almost 11% year over year. Now that tells you companies are not looking to grow, right? So again, where's this PE multiple going to be coming from? And one of the reasons companies aren't adding new jobs, looking to hire people, well, look at how many hours people are working, right? Because if you're going to hire new people, the reason you're hiring new people is the people you have working for you, they can't work any more hours. So we want to look at hours worked. That's a little bit less leading, but we always like to look for confirming data points. You don't want to look at just one data point and say, oh, I've got the picture. So if we look at hours worked, well, total hours worked has slowed to its weakest read since 2010. We have a chart for this as well. So you've got people working less hours and you've got fewer jobs getting posted. That's not telling me that employment is looking so fantastic in the future. We've also got the ISM Manufacturing Index. That's at the lowest level since June of 2009. I mean, we all remember that. That wasn't such a great time. And new orders, which is the most forward-looking component of manufacturing, That has been falling since September of 2018. Not consistently, but it's overall, it just keeps kind of going down since September of 2018, which tells you that's slowing. So last place to look, right? If we've got the government spending like crazy, you've got businesses looking out in the future, not super ambitious. Well, what about the consumer? How are they doing? Now, I think, you might have seen that the conference board published that consumer confidence is really, really high. Like the headline number on consumer confidence from the conference board was, oh, it's fantastic. They're feeling great. Again, kind of like GDP, look into the details. And if you look at the confidence for the prime working age, forget people who are retired, look at prime working age, the 34 to 54-year-olds. That's declined from 142.5 in July to 125.9. That's a really big drop in a short period of time for people who are actually going to work every morning. That, again, we look for confirming data points. That confirms what we saw with job openings and with hours worked, right? Mm-hmm. So both of you put those two together and it's like, all right, things are not looking so good. We've seen those expecting higher income has been falling. And again, okay, final last thing, unemployment. Because people keep talking about how low the unemployment rate is, and that's fantastic. Well, I mentioned that employment is really not a leading indicator. Unemployment is actually the most lagging, because with employment, right, you wait until the last second to fire someone. You don't want to do that. So unemployment is even further. Well, looking throughout history, the last time unemployment was this low, roughly, was in December of 1969. A recession started the next month. So outside of where we are today, the last time unemployment was super, super low, a recession was right around the corner. So super low unemployment rate doesn't mean that the economy is doing great in the future. It's more backward looking. And finally, if you want to look at how consumers are how much money they're making, I like to look at the non-supervisory and production employees. That counts for about 80% of the population. Now that has been, if you look at this, and if you follow me on Elle's Economy, Twitter, at Elle's Economy, I keep posting this pretty regularly, showing how every decade, the average hourly earnings for this group has continued to decline decade after decade after decade. And it is still at the lowest pace in 15 months, right? So they're not doing great things. And that makes sense. Another confirming data point. If people aren't working a bunch of hours, if you're not looking to hire more people, why would you be paying the people you already have more and more and more, right? So there we've got a bunch of confirming data points that all tell us, okay, this picture seems fairly consistent. But Jay might be asking, what about those rising stock prices? How is that happening, right? Any ideas?
Printing money, baby.
Exactly. That printing money. And where's that printing money going? That printing money is going to companies borrowing a ton, right? We've got corporate debt, the likes of which we've never before seen in history. And all that their money they're buying, they're using it to buy back their own shares, right? It's all these share buybacks. In fact, if you look at what's been going on over the past quite a few years, really the only buyer has been companies. They've been buying so much that they keep pushing their stock price up. Meanwhile, households have mostly been selling, which also makes sense when you think about the demographics. You've got baby boomers moving into retirement. At that point, you have to start living off your savings. You're not increasing your portfolio, you're living off of it. And you've got the millennials that are dying from all the student debt. So they're not hopping in to buy the stocks that the baby boomers are selling. So again, confirming data points that all kinds of make sense. If you want to know just how bad it is with companies right now, a full 16% of all US companies are zombies. Now, a zombie company is a company who can't even generate enough cash just to pay their interest expense. So that's basically you're not making enough money to pay your mortgage. So you're using your credit card to pay off your mortgage. Now, in 1980s, that number was 2%. Today, it's 16. And finally, a few more little indicators that we tend to see towards the end of a cycle: accelerating M&A that's been paid for with cash, and a sharp decline in the IPO calendar. And that we've definitely seen where that's crashing because companies are like, oh, I don't know, these markets, that's not looking very good.
Mm-hmm. Well, so that's a lot of negative data points. What this audience are financial advisors. What do they do?
Well, what you want to do is you want to look for those areas of opportunity, like we said, you've got a lot of opportunity when you're looking at the defensive stocks, right? Because the government's spending there. Another thing we can look at is what's going on in the bond market. Now, if you've got all this slowing growth, and now with what's going on with the coronavirus is really, really slowing growth all over the world. I mean, we've never seen something like this. We've never seen where a country that accounts for roughly 20% of global GDP is slowly but surely being isolated from the entire global economy. And this economy, China, is key to so many of the supply chains, right? Think about how many things that you buy that are either assembled in China or made in China. You walk around your house. Well, how's that going to work in the coming months if this thing gets worse? We don't know yet. Maybe it just passes over, but maybe it does get worse. So with that means, and everybody's panicking, right? So you've got airlines shutting down. You've got most American companies like, hey, guys, stay home. Don't go to China. Or if you're in China, stay home. Don't go to the office. So that means a lot less growth. Well, with that means that bond yields are going to be flowing down. So that's another good place for safety. You've also got utilities that's a defensive thing, and that's got a nice yield on it. Those will be very good. You've also got gold, which has pretty much a complete inverse correlation with bond yields, and also taken in context of the bigger picture. When you have an economy where there's a lot of negative yield, an asset that yields nothing actually looks pretty positive at that point.
Mm-hmm. Tell me a little bit more about your thoughts on the coronavirus as we wrap up, the implications, and really what advisors should be looking for as they're constructing and managing portfolios.
Well, this is a dynamic situation. So this is a really tough one, I think, for everyone managing money, because you just don't know. No one knows. You don't have enough data that you can rely on, right? We all kind of know that the data coming out of China, there's reasons to suspect it. That's just, they've got a history of the country's not exactly transparent. And something like this, they're really not going to be transparent. At this point, the number of cases has been exploding, and we don't know. There's two critical things, and these are things to be watching to try to get your head around what we're dealing with this virus. There's the transmission rate, and then there's the fatality rate. Now, the transmission rate is really difficult for us to figure out because this virus, you can actually give it to someone else when you have no visible signs of being sick. And that's very different from SARS. So that makes it tough to understand what the transmission rate is because we don't really know who all has it. And the same thing with the fatality rate. This thing's transmitting because we don't know who has it. So there's so many people who are catching it. The number of people catching it is growing so quickly. It's growing more quickly than the fatality. We don't really know what the fatality rate is because if you're thinking about it, the math, right? The top, the bottom, when you divide by the bottom, that keeps growing way too fast. So we don't have a good accurate number on just what the fatality rate is. But we can kind of get a head around this to think about, well, what happened with SARS? In the SARS scare, the S&P dropped about 9% from its high to its low. The yield on the US 10-year fell over 110 basis points. The VIX went from 24 to 34. Oil prices dropped over 30%. And emerging market major equity indices lost around 12%. So that was back in 2003 with SARS. But if we compare that to now, back then, we were already kind of in a bottom, right? Think about 2003. We were right near the fears of a double dip recession from the late 2002s with the Enron WorldCom crisis, and nobody trusted the publicly traded stocks. Everybody thought everyone was out to get them, and the world was kind of a scary place. Back then, the cyclically adjusted price to earnings multiple was 22 times. Today, it's 31. Today, that thing is at really one of those all-time highs. The combined market cap, just to give you an idea of how different multiples are now, the combined market cap of Amazon and Apple is more than the combined stock markets of Germany and Australia. I mean, that's just amazing. Two companies in the US. If you look at the price to book for the Dow Jones 30, it was 3.2. Now it's 4.5. I can keep going on and on. Investor sentiment back then was positive sentiment was 22%. Today it's 46%. And you've got going into the SARS virus, the VIX was 25 back then. Now it's 13. Right. So right now we're very much more at a peak, where back then we were at more of a trough. So the dynamics are very different when we're looking at the stock market. And if you want to look at the economy, in 2003, China was all of 4.3% of global GDP. Today, it's roughly 20%. So we've just never seen something this big. China accounts for 12.5% of all global air traffic. Again, we've never seen something like that. And that global air traffic around China to do with China is all coming to a grinding halt. How is that going to affect overall global GDP? These are all kind of TBD. We don't really know, but what you can do is at least get some defensiveness there. You can be looking at the defense sector because that's going to be doing well regardless. The spending in defense sector is not going to change because of the coronavirus. We've got every reason in the world to think that bond yields, because you look around, there's so many signs of global slowing. And right now we just had the 5-year and the 2-year yield curve inverted. Again, that tells you that the short-term yields are too high. That's some downward pressure on bond yields. That means bonds could be a good place. And I think any kind of bond-like instruments are going to be good as well.
Excellent. Lenore, thanks for coming on to share your macro thoughts. If anybody'd like more information, visit Tematica Research. Follow her on Twitter. Your handle is L's Economy? Is that correct?
Yes.
Excellent. Thanks for coming on.